Joining us right now to talk more about the Fed and everything going on in the markets right now is Rick Rieder. He is Chief Investment Officer of Global Fixed Income at BlackRock. He is also the head of the global allocation team there. And Rick, let's first of all, before we get to the Fed, just talk a little bit about what you're seeing in the markets right now, because obviously things have been changing pretty rapidly. The last time we spoke with you, you said that the health was kind of returning, that there were opportunities, particularly in the bond market. Is that still what you're seeing today?
Yeah, totally. I mean, the thing that's amazing, Becky, and I think will be persistent, is when you think about what the Fed's putting in, you think about all the fiscal stimulus that's coming in. The grab for assets or the need for assets is just extraordinary. I mean, when you take some of what Steve was describing, the Fed is buying, like you say, it could take the balance sheet up to $12 trillion. You know, one thing, we didn't see this in the great financial crisis. You're talking about a Fed, or you didn't see it for a while, I should say. You're talking about a Fed that's buying huge amounts of paper, taking it out of the fixed income market. By the way, you know, we talk about the fixed income market as the aggregate index. When you take what the Fed's doing, they're buying about 20% of the whole ag index. Anyway, part of why this equity market, part of why the equity market keeps rallying, and it's probably the most hated rally in history, or one of them, is it's not necessarily because valuations are cheap. It's not necessarily that things are cheap in fixed income. There's so much liquidity that's been put in, and I think that will continue to be the case in fixed income and equities going forward.
Rick, when you lay it out like that, that's kind of phenomenal. If they're 20% of that market, buying 20% of that, what would happen if the Fed wasn't there?
So there's a couple of things, and I think what Steve said is really, really important. There's one critical thing. What the Fed is trying to do, they're not trying to be in the high yield market. They're not trying to be in the CLO market. They're not trying to be in the municipal market. What they're trying to do is make sure the markets are operating. They're making sure they're functioning. And quite frankly, oftentimes when you show the bazooka, as we talk about quite a bit, you don't have to do it. And I think like Steve was describing, they've put so much in there. And there's so much talk about the Fed's buying high yield. First of all, they're not buying yet. And secondly, they're not really going into different credits in high yield. They're doing a bit in ETFs. They're doing a bit at the top part, the highest rated part of the CLO market. So anyway, if the Fed, and I think what the markets, myself and everybody in the markets feels comfortable with, is if the Fed is there as an emergency backstop, if they're there in case that the system has an issue, the markets can operate. By the way, we're breaking records of investment grade credit supply that's coming to the market, and we're going to do it in May. I think the number is another 250 to 300 billion will come in May. Because the Fed is doing what they're doing, the public markets can finance investment grade companies, and that's really powerful. If the Fed wasn't doing this, it would be an issue.
So last time we spoke with you, you said that you think the real opportunities are in the bond market, that's the better place to be, in part because there's less risk there. Those bond creditors would come before equities holders. You still feel that way?
So, Becky, I have to say, I mean, in some of these markets today, it's so idiosyncratic. I mean, think about where equity valuations are. I mean, the market's not cheap anymore. You know, I think we were on your show back in the end of March, beginning of April. You know, we talked about the equity markets ran up 20. I think we ran up 28 or so % from the bottom. And, you know, people talk about don't buy anything, don't buy anything. You had that's like 3 good years of performance that you had. And by the way, so, you know, equities, when we do valuations, we look at equity risk premium, we look at multiples. It's not really that interesting. By the way, I think it will grind higher because of this incredible liquidity and the need to put money to work. And with the Fed taking yields so low, there are parts of the credit markets, but it's so hard to say. When people say you're buying high yield to buy investment grade, I'd rather buy a high yield cable company than an investment grade retail or energy company today. So it's hard with those monikers. But like you were describing, there's some rescue financings going on. There's some places where you get real yield in the high yield market that you don't have to take leisure risk or hotel risk, or, you know, there's some airline things that are interesting. So it's really idiosyncratic. And I would say today there's some opportunities in the bond market. And I hear the expression all the time, it's a stock picker's market. And I'm not sure in the last 10 years that was necessarily the case. But now I actually think it's idiosyncratic. I mean, I do think there's some income stories. And one of the things we're doing in all our portfolios, get income, get cash flow into the portfolios. And that's the primary driver, whether it's debt or equity.
Okay, so watching what the Fed does today, I know you've said that this meeting's important, but you think the next meeting in June is going to be the most important meeting for the Fed in maybe 10 years. Well, why is that? What happens next month?
Yeah, I think the way Steve framed it, is right. This is a historic meeting. But it actually, everything that the Fed has done, everything the Fed has put in place today, they're not going to make. There's a little tweak on the interest on excess reserve calculation they may do, but there's not. I don't think we're going to hear a tremendous amount from the chair or from the Fed statement that is going to be significant around implementation. But, you think about if you were the Fed now, you're going to get a lot of employment data between now and the June meeting. You're going to get a lot of data on the economy. You're going to get a lot of data on how much treasuries you're going to issue, including a 20-year issuance. In June, you're going to get a much better sense. If I were the Fed, and I think that's what they'll do, sit back now. You've done an awful lot. And then in June, I think they're going to lay out the dynamics around average inflation targeting, what the philosophy is going to be going forward, specifics around the buyback program, et cetera. I actually think the next meeting, when they have more data, is when we're going to learn more about the intermediate term to long-term progression of where the Fed is. So that's the meeting, I think, given everything they've done now, that I think is going to be really interesting. By the way, the ECB is doing a similar thing, and it's a question of whether they're going to do the same tomorrow or wait till June to lay out more of these asset purchases.